So last week we kind of did an intro to FMAX. And let me share my screen here. Let's see here. All right. So does everybody see my FMAX dashboard here? Somebody give me a thumbs up. All right, cool.
Yeah, we can see it.
So basically we did an intro last week and we really focused on, kind of what's in here under the hood in terms of strategies and just by way of review. So if I come over here and I should restate that I'm technically in my Wellscape. So if I click over here to FMAX dashboard, get into it. So this is what all of you guys now, I can't see all of you guys at the same time. I have you kind of minimized, but did some of you guys get just by maybe audio get in here and play around with this in the past week that have access to it? So guys, there's no substitute for getting in here and just spending some time running proposals and running different research and just by way of review, we're gonna do this in 1 minute, but just it'll segue into where I want to go today. So if you go to research and then you go to strategist, right? I should have clicked all solutions. This will pull up and then expand it here. This will pull up all of our different strategies here. And we talked a little bit last time what makes a separate managed account or SMA different from a fund strategist profile or a strategist different than a UMA. And these are just mutual funds. And so go back and review that training for that. But what FMAX does is it brings all of these together and you can kind of build a portfolio. So the two things I want to focus on today and hopefully get through will be a function of building models and then running proposals. And those two things kind of go hand in hand. And then the only step we're not going to get into at length today is just going to literally be, and I'm going to show you where we leave off, is just going to be actually opening the account. But once you've built a proposal, assigned a model, really it's a couple clicks of a button, and that gets you to the account opening process. And I'll show you right where that is. And then from there, you guys, the magic of this is getting in and tearing it apart and building your own models and playing around with them and seeing where they end up. And so we could probably start this on the model side or the proposal side, but I'm going to start this on the model side. So if we go up here to manage and then click advisor models, that's going to take you. So you can see I have a couple in here, and I was trying to throw together one last night. I was kind of running on fumes last night after a bunch of meetings in the field all day, and I couldn't even spell moderate right. So if that gives you guys some hope, you have a lot of upside in this business here. But I'm going to take you guys through how do you build a model? What does that look like? So if you go over here and you click this plus sign that says create model, and we want to focus on this TFA 365 unified managed account. So let's build a moderate model. Let's say I want to do a moderate. I did it again. Moderate, and I'm going to say um, qualified. So I talked about in my training last time how I'm going to kind of, when I'm done with this, build two sleeves. And again, this is me. You don't have to do it this way. But I'm going to build like an aggressive down to a conservative qualified model and then a non-qualified model. And so the qualified model, because that's going to be for IRA accounts and rollovers and Roth accounts that don't have any tax consequences year by year, I can use some strategies that are a little bit more higher in turnover, maybe a little more trading, so a little less tax efficient. But on a non-qualified, I want to use more tax efficient strategies. So by way of review, we talked about there's five primary fund families. In fact, I'll get to that in a second here. So let's just say risk tolerant. I'm going to click moderate here. I'm going to pop in my rep code. And for reference, anytime you guys open up an FMAX account, you always want to put ref code A14. That's the key to your success here because if you put my rep code into all of your accounts, I'm just teasing. All right. Trying to make this fun. Drift, we want absolute. I can't actually tell you guys the exact difference between this, but in general, what drift means is if I put 50% in strategy A and 50% in strategy B and strategy A outperforms, yeah, I'm going to have 52, 53, 54% in that strategy. And so how much do I want that to grow before a rebalance triggers? That's kind of what drift is. and there's default drift. I don't know if it's making me put something in there or not. Let's just leave that because I can change it up here. So that's going to give you into this dashboard right here, okay? And so if you look down here, our target here is somewhere in this like middle pie, or whatever on this speedometer looking kind of thing right here. And I think what's going to happen is this little black triangle is going to move once we start assigning some models. So we're going to go in here, and if I click on this magnifying glass, now I can do one of two things. I can either type in something. So this is where you want to spend some time on researching and figure out, okay, what are the key strategies I want to use for my models? And because once you're into this environment, it's harder to look under the hood. Okay, well, what is this BlackRock model and what's this Fidelity model, so on and so forth. So if I just go down here and I'm going to do all security types, and I'm going to do, let's see if all styles, and I do search, it's going to, well, maybe I don't want to do that. Let's see here. Manage portfolio. Oops. All styles. All right, here we go. So this will pull up kind of all of these different strategies on there. But if you're trying to figure out by just the title of the name and you don't know what you're doing before you build this model, that's not going to really work for you. I don't know if the company's going to do this or not, but they might build some basic models that you can just utilize if you want to be determined. But let's start with this. I want to start with, because this is qualified, and I did qualify it on purpose. I'm going to show you guys some different strategies. So if I use, let's just type in BlackRock, for instance, and then search. This is going to pull up all the different BlackRock options. And what you're going to see just on BlackRock options is this is extensive. So you have these global allocation options, which have a $25,000 minimum. Those are going to be a little bit more actively managed, compared to like a pure passive index. But then if you want a pure passive index, they're going to have these ETF options. And then if you're feeling a little bit liberal, you can do the ESG options. And so that's if you put your DEI flag behind you and you do all that stuff. So I probably won't do that. But what you have here is so I'm building a moderate model. So in my opinion, a moderate model kind of baseline is roughly 60% stocks, 40% bonds. But this is where I have the ability as an advisor to say, how can I build a model that's moderate that maybe doesn't use 40% in bonds? Because just as a general belief personally, I don't want most of my clients to have that much bond exposure. So let's start with something. Let's say I BlackRock, they have, I could choose a 60/40, I could choose a 70/30. But let's just say for argument's sake, I'm going to choose a 60/40, and I can put in, let's say, 40% of my model in there. But let's say I don't want to put everything into BlackRock. And see it's wanting me to put a drift in here. I'll just put 2% just to put something in there. Now I'm going to come down here and let's say I want to do multiple fund strategists because I want to have some diversity. So let me choose I could choose Fidelity, which I like a lot, but that's for more of my passive. Let me choose Goldman Sachs and see what comes up. This is where you got to kind of play with it a little bit. So manage portfolio, all styles. So now I got Goldman Sachs. And let me say Goldman Sachs, I want to be 50/50. And you'll see why in a minute. Because one of the things that I want to do, I'm going to do the same drift over here, is I want to use, in my personal opinion, like 20% of the portfolio. I want to go directly into the mutual funds, because then I can control a few more. So if I come down here to mutual fund, I still have all styles, I search. So now all of these funds are going to pop up. And I think in the next update, you're going to see this list become a little bit more robust. But in here, this is where you're going to find most of these are Fidelity index funds for like 3 or 4 basis points. So if I wanted to overweight the portfolio towards equities or bonds or US or international or emerging market, whatever I wanted to do, this 20% gives me that flexibility. You're also going to find the Calamos strategies in here. So if I wanted to use like Calamos hedged equity as a bond proxy, I could do that, and so as an example. But for this example, I want some S&P 500 exposure. Let's say I want 12% there. And then let's say I want to add one more row. Oops, don't want that. I want to go here, go back down to mutual fund, and then I'm going to search. And then I like overweighting a little bit of large cap growth. So large cap growth index. So if I'm doing like an aggressive model, I might go 12% growth, 8% S&P, or I might go 15.5. I mean, you guys can play with this. I mean, you're the advisor here. That's part of having a Series 65 license. So let me minimize this. And let's say I want to, okay, so before I save this, look down here. Here's what's really cool about this. So I just plug that stuff in. Now see where our triangle is. And so you can see by me adding this 20% is pure equity. That's why I chose 50-50 on Goldman Sachs. Because if I chose 60% BlackRock, 60% Goldman Sachs in terms of the equity, and then added another full equity, that would have bumped me up into moderate aggressive. So by choosing 50-50, how did I know that? Well, that's just hours getting in here playing with all this stuff, okay? So you guys can do that so you can kind of see where you want your dynamic kind of range to be here. But here's what's really cool is just by plugging that in, it's gonna assimilate all four of those funds together and it's gonna show you what the underlying structure is gonna look like. So I've ended up at let's see here, 54.6 US equity, 11.8. So I'm at about 65, 66% equity, which is still in the moderate range, but I'm kind of at the upper end of that, which, lines up right with my triangle right here. I'm only at, 31% fixed income. So I like that a lot, only 1.6% of cash. But for me personally, I like how this is weighted. Like I like how way heavier in U.S. and international, which to me is a long-term belief. And in fact, it simplifies it even more right here. I like how I'm overweighted large cap over small and mid, and I like how I'm overweighted growth compared to value. So core is going to be kind of a blend of growth and value. But I'm at 13% growth and only 2.4% value. So I've weighted or I've tilted the portfolio towards growth. If I wanted to tilt towards emerging markets, well, I could easily do that by one of two ways. I could either, spend some time on research and figure out you're going to find some of these strategists use more emerging markets than others. So that would be one way. To make something up, let's just say American funds I discover uses emerging markets more than Fidelity or something. That'd be one way. And the other way is I could take that 20% and then, allocate directly into an emerging markets fund if that's something I wanted to do for a client scenario. So I'm going to save this for the sake of training. So let's go save and activate. So now I've just created this qualified portfolio. So I'm going to go back here to manage advisor model. So now you see that pop up right here. So the other thing I want to point out while I'm here is you'll see that the minimum for this model is 62,500. So what you're going to find is you can take a client all the way down to $10,000 on this platform. But if you have a client with $12,000 in a Roth IRA, you're probably going to plug them into one fund strategist profile and move on. With the 10, you're not going to be able to, because each of these strategies has a minimum. And so by choosing, one that has a $25,000 minimum, one that has a 10, I mean, I could easily get this down by just putting 80% in one fund strategist, but I chose to use Goldman and BlackRock just to kind of show you guys the differences. So you guys hopefully can follow that. So what I'm showing you here is you can build out your models the way you see fit. And then the beauty of these models is once you have clients assigned to models, for every client that I have assigned to moderate and qualified, let's say, because 3 years from now, I might have 100 clients in that strategy. If I just see, okay, Goldman Sachs is really just not doing well compared to BlackRock, I'd rather replace Goldman with Fidelity. I go make
Can I
that
give you a
one
couple to
change
see how
and
long
it's
you're
going
going
to
to be?
allocate all of that. I'm sorry?
Okay, yeah, I'll give you a call back right back. Okay.
Oh, okay. So I make that one change to my model and it resubscribes everybody the next trading business day into that model, which is absolutely incredible from a scale and a business management standpoint. But the other thing this will allow you to do is I'm going to now show you how to build a proposal. And so once you get to a certain point of proposal, you can do one of two things. You can click a box I'm going to show you where you can just pick your model and plug it in there and you're done. Or you can build a custom model for that particular client. So let's go into this. And so now if I go to, let me go back to home here. And you're going to see these quick actions, which you can control right over here with settings. So let's say I want to create a new proposal. So I'm going to create a new household. We're going to go Joe, Andrea, Kaiser. Joe happens to be in my view, so I'm going to go Joe Kaiser, rep code, plug it in there. I could add a family member. I could plug his wife's name and create a separate side profile, but for argument's sake, we're just going to go right here. And then I gotta, one thing about doing this via Zoom is I'm constantly moving the pictures of you guys around so I can get to the buttons I need to. So I'm going to click down at the bottom right, save and continue. So this is going to take you into risk tolerance, and this is not unlike what you see at Goldman Sachs. So I'm going to click get started. And Joe and Andrea are going to be aggressive. Well, actually, I should go back. Let's say they're going to be moderate. So I'm going to use my moderate model. So I'm going to answer these questions kind of in the more moderate or middle of all these things here. So we're going to, hold securities and we're going to sell half the securities. I'm just going to fly in through this just to kind of get to an end result. So I go through 6 questions, and guess what? We're in a moderate tolerance. And so how we do this in my business is we pretty much I just know what my client is based on my conversation with them, and we get their risk tolerance to where it needs to be. And I'm going to now save and continue. And I'm going to follow this flow chart up here, so now we're under account strategy. So this is the point I was just kind of starting to describe. So Joe and Andrea have $500,000 to work with, just a little side cash. And let's just say, since we're doing a qualify, let's just say it's an IRA, it's in Joe's name. Now, I'm going to just put a plug and come back to this potentially today or another time. But this is another example of like having a platform versus a siloed solution in Goldman Sachs. You see down here, tax management and values overlay. Well, tax management, these are 2 options you can check if it's appropriate. So, for instance, tax management is something you wouldn't do unless it's a non-qualified account because there's no taxes to manage. It's all deferred until you take income. But if you have a non-qualified account and you click that button and we go down that kind of trail, it'll basically manage the portfolio more tax efficiently and kind of help you choose different strategies and manage cash flows. It's a really cool kind of value, overlay Fidelity does. And a values overlay has to do with, let's just say you have a client that's got certain beliefs and doesn't want to own any tobacco companies or doesn't want to own any I did a proposal for a nonprofit and, they were very specific on a certain issue and we were able to screen issues out that were related to their nonprofit. Turned out we didn't get the business, but that was just a relationship thing they had elsewhere. But the point is you have some different functionality here that's really cool. So now we go into $500,000 we have in an IRA, and we can either select an existing strategy or create a custom. If I choose create a custom strategy, so let's pretend this is a $15,000 account. I just need, I would just know, okay, it's not going to fit my model because I need $60,000 for the model I just built. So what I would do is I would click the TFA Unified Management Program. I could name it whatever I want. I could start building it. And then I'm essentially going to do the same thing I just did, but it's just going to be for this account. Now, if I do that, that means, so let's just say this is a small account and I do that, that means this account's doing its own thing. So this would, for all intents and purposes, be like what you currently have at Goldman Sachs, meaning this client subscribed to this listing of strategies. So if I ever wanted to reallocate this, I'd have to go into this particular account and reallocate this particular account. Everything I have assigned to my models, I can manage the models. And so where you're going to see me go with this is I want to have as many of my clients in models as I can so that I can manage my business over time. So I'm going to back out of this and I'm going to choose an existing strategy. So I'm going to go back to the unified account, start selecting, and now it's going to pull up of all of my models that I've built. It's going to pull up all of them that fit this risk profile. Okay. So I have this moderate profile right here. I'm going to select that. And I think I'm good here. So I'm just barely at the top end of that risk assessment. You see how because it's qualified, the tax piece went away because it wouldn't be applicable. So it'd only be a values overlay. And I want to come back Alec, can you remind me to come back to just tell me to come back to SMAs at the end here before I forget. I want to show you guys something else there. So save and continue. So now I can choose, okay, how do I want the cash to be managed? So if I click this plus, there's this idea of dollar cost averaging or protected cash. That has more to do with like if we're investing a lot of cash and I want to, if I click this, I can say, hey, I want equal buy-ins for 3 months or 6 months or 12 months, and then the system will just automatically do that for me. Protected cash means sometimes, maybe we move $500,000 here, but we're going to send half of it to a variable annuity somewhere, but we're just parking it here because we can only do one rollover from a 401k plan. I could do protected cash, which means it's not going to invest whatever amount I plug in there into the strategies, and it's going to keep it idle until I do something else with it. And then it's going to force you to choose a rebalance. I typically do annually here, so I'm going to click this plus sign. Oops, I'm just going to add here. I'm going to click annually. And then I'm going to save and continue. Now we're getting to fees. All right, now this is something cool. That's a little distinction from Goldman. So this is going to start with the base platform fee schedule as it is. So you're going to see on here the firm fee is 14 basis points. That's TFA's fee. Program fee is going to be the fees for all these strategies I build, which by the way, I mean that's incredibly cheap. That's Goldman, that's BlackRock, and that's the not no load mutual funds. If I wanted to shave that down even more, I could choose like if I chose a Fidelity fund strategist profile and then a couple funds, I mean this fee would literally be like 4 basis points. Okay, so you can get really cost competitive if you wanted to. So my total fee to the investor is 1.4%. And if you can expand any of these, it's going to show you what the breakpoints are. So that 1.4% is a net fee based on these breakpoints here, okay? Because we have a $500,000 portfolio. But if I go up here to my fee, okay, and I click on this little pencil icon, well, it's going to break up. And this is the way they have this program right now, which is interesting. So back to this idea that they're taking the training wheels off. TFA has all these built-in breakpoints, but for some reason they have them plugged in at 1.1% on all of them. And so you have the choice if you want to create your own fee template. Okay. So I'm going to show you this in a second. But so now it's kind of like building a model versus building a something unique for this account. So what I'd recommend to you guys that I'm going to show you in a second is I've built a fee model. So I made a decision on what am I going to charge on this platform as my standard fee model. Um, Knowing I can go in on a per account basis if I need to get more competitive in a certain situation. So here's what I've discovered about my business is that, $45,000 account takes just as much time as a $450,000 account, and often it's all those small accounts. I mean, right now I'm chasing clients down, getting them to fund their IRAs and their SEPs and their Roths for last year, this year, all that kind of stuff. So I'm actually increasing my fee on this first breakpoint. So if I click, so I've created this standard fee schedule for me, okay, and this is my standard fee schedule. So now every client I subscribe to, I can just pop that button and it's going to automatically put that fee schedule. So what I've done is I'm actually going to increase my fee to 1.25 on the first 150,000. You guys don't have to do that, but TFA is giving you the latitude to do it. And the other component is as I move clients from Goldman to here, because the strategies are cheaper and the platform is cheaper, I'm still going to lower the cost to my client by 5 or 10 basis points, even with this increased fee on a small account. but I'm going to get paid a little better for the work I'm doing in the field and the service and all that kind of stuff. And I think you'll find in the industry, this is not uncommon. Most RIAs, if they're willing to touch anything below $250,000 and more, they're not willing to touch anything below $500,000. They're going to charge more on those smaller accounts just because the economics of the dollars need to add up. And so this is my standard fee schedule. And I just created my own breakpoints, just kind of like what Goldman is right now. I just drop it by 10 basis points at every breakpoint. And so I can just click apply. Now I do that and it changed this fee right here. And so actually on a $500,000 portfolio with my breakpoints, instead of 110 on everything, for what it's worth, it went down 1 basis point because I'm making more on the first 150 and then less by the time I get down to the 250,000 to 500,000. And it shows the breakpoints right there. Okay. And one thing I would tell you guys, just from a training or mentality standpoint, I used to be so afraid of fees, commissions. I used to be afraid of words like life insurance or annuity because I'm like, if I say a word and they Google it, like what it, and as my confidence in the value I deliver to people has grown, man, I'm forward about my fees, and I say, you know what, for 1.09%, you get me, you get all of my experience, you get my cell phone number that you can call at any point. You got my personal email address. You've got me meeting with you at least once a year, either, in a live meeting, it could be Zoom or in person, doing a deep dive on your portfolio and all of the financial planning stuff you do. You've got the e-money, you've got all the stuff we've done, right? And I mean, I just wouldn't have the book of business I have today if people didn't find value in that fee. But I just want you to, sometimes we get in a tunnel here and we think about our fee and I think, my gosh, compared to what most people have, because most people have a 401k and they have an 800 number they can call to some like goober in a call center that graduated college last week that they'll never talk to again. They could call that number 10 more times and get a different person every time. Doesn't know their goals, doesn't know their situation, limited on what they can answer. You guys, that's what it's like. I met with a client recently in the past week where now I'm not a tax expert, I'm not a CPA, I'm not licensed, I think most of us aren't. But you got to understand taxes and basic things and he was explaining because he has a W-2 like wage and his wife is kind of a freelance like 1099 contractor kind of person and she has her own business. And I'm like, well, because they're really tight on cash flow. And I said, well, are you guys writing off business expenses, cell phone and home office and mileage and supplies and all these basic things that she probably has? And he answered, he's like, well, no, because TurboTax doesn't let me. And I'm like, what do you mean TurboTax doesn't let you? And he's like, well, because we take the standard deduction. And not to go down that whole conversation, but the guy clearly didn't understand, like, you can write off business expenses before you get to your net business income, and then that flows to your personal return, and then you can take your either the standard deduction or itemized. But you guys, a business deduction is not the same thing as like I gave $400 to the Little Sisters of the Poor, but I can't claim that if I itemize my deductions or if I take the standard deduction. My point in all this, you guys, is what is it worth to pay an accountant $500 or $600 to do your return and have the advice and the holding of hands, along the way? I mean, it's worth its weight in gold. I mean, the $50 he's paying TurboTax every year is costing this guy a fortune, right? And I just want you to, I give that as an example about our business, you guys. I mean, what's it worth for a client to have? In addition to me and my value and my experience and convincing him not to panic when the market goes for a correction like we're in right now and all this stuff, right? What's the value of that on top of what's the value of having him feel comfortable with, hey, let's go ahead and get you 80 or 85% in stocks versus like a 20, 30 target date fund that's going to have you 55% in stocks? What's the cost of that over the next 15 or 20 years? It's enormous. It's enormous. Um, Anyways, I could give you guys examples for days. But the more you feel like, man, I am worth every penny of what I'm charging my clients, that's a very powerful position to be in. And then you can defend your fees like with confidence. And I've I've never had anytime a client said, well, I had a client's accountant that like kind of more of a bookkeeper person. I managed his 401k plan. There's over $1 million in the plan, between his employees, and she pointed out like, well, your 401k fees went up, I don't know, whatever it was, $800 from last year. And she's trying to like add value of like, hey, look, I'm looking out for you. You know, somebody's increasing their fee. Well, he sends me this email. We have a great relationship, and I think he was a little awkward about asking, but he's like, I just want to make sure everything's okay. Like, do we need to adjust anything? And I'm like, I called him and I said, John, your fee's going up because I've made you a lot of money. Your account's worth like a couple hundred grand more. Like the plan has more assets. And so you actually pay I just explained, he's like, oh, well, that's great. That makes a ton of sense. Like you just go in strong with defending your fees. So, anyways, off on a fee tangent, but I just hopefully that's some value, you guys. So you build your models, you build your fee templates, and then you're pretty much done here. So I'm going to click I agree to the fee schedules. I click continue. And boom, here you go. So here we have a kind of a proposal for Joe and Andrea Kaiser. And so it's going to show me right here, the breakdown of exactly what the allocation looks like. And then all I can do over here is I just click this white button, generate documents. It's going to take a second to calculate. And then what's going to come up here is every single form that you're going to need to get this account moving. Okay. And all of it will eventually go to like a DocuSign type environment. But I'm going to click all real quick. Here we go. So now this shows you all the different forms. So all the disclosures, all that kind of stuff. And you can read through the relationship summary and all the new stuff that they've added here. But I'm going to click on this investment strategy proposal. And you guys, this is worth its weight in gold. So I open up a PDF. Are you guys seeing the PDF now? It's got our new Transamerica Financial Advisors. Who knows how much time and money we spent to have a little different looking pyramid, but that's above my pay grade. So this is something we've never had with Goldman Sachs, which is we've never had a document that you could email or hand or leave behind of like, here's what I'm proposing we do with your portfolio, which I think is incredible. So you go down here, it's branded Transamerica. It's going to do the overall summary right here of the allocation. It's going to give that same breakdown under the hood. And then what it's going to do is it's going to go through, it's going to show you recent performance of all the underlying components of your model. And so you can talk through this how you want to do. And then it's just what it's going to do is it's going to add the fact sheets for every model that you have. And so I can go through and I mean, you guys, you print this off in color, hand it to somebody, you look like $1 million, right? It looks like, I mean, it looks like what it is. Hey, we have a plan, we have a process. This is how we build and manage portfolios. This is the value. I mean, you're just dripping with value here in terms of what you're doing because a lot of people just because you can do this by yourself, just because Joe in our example could open up a Schwab account or an E-Trade account and he could buy index funds and all that. 90% of our population, they have no, where do I start? What do I buy? What's rebalancing? How do I manage this? They need help with all this, as you guys know. And so I think this gives a lot of people a lot of confidence. It makes it, this makes it a lot more duplicatable for me to train on because I can show it's got my mutual funds in here that I built, but I can then help the client. I can walk through things like, hey, this fund on its own is volatile. I mean, in 20, we're up 38, up 27, down 29, up 42, up 33. I mean, this is a ride, especially in those 2021 through 2023 cycle. But this is just one little component of your overall strategy. But when we put this all together, it's only 8% of the total portfolio. But we go up here and it's going to contribute to overall returns. And so you can go back and you could run a research proposal that would put all this together in a hypothetical. But you guys, anyways, that's a good place to pause here. I've gone through a lot of stuff. Any questions on what we've covered here so far?
Hey,
Hey, Tyson, before you do that, when do you want to do the SMA?
I will come back to that. Thank you. Yeah, for sure.
hey, Tyson, I did have a question on the cash balance. Do you know if it's possible to have like all dividends sent to the cash balance and then have the fees pay out of there like we do with Folio, or how does that work?
I would assume there is, but yeah, that's probably a setting. Yeah, you could set dividends to cash.
Okay.
Um, yeah, there's no reason. I mean, yeah, by
Okay.
default, if you
Perfect.
set dividends to cash versus reinvestment, and they're going to pull fees from cash, so there you go.
Okay. Perfect.
Tyson, Anthony, a quick question. Have you noticed
Yeah,
any discrepancy on what the investor fee is versus what the paperwork they sign is? I was just doing my first one and I noticed it was higher on the actual proposal and than what we were seeing on what you were showing.
it was higher on the proposal than where?
Where they got to sign, like for whatever that document is here. I think it's the other one you didn't show.
So we went into that a bit last week where if you pull up, if I get out of this environment, I'll keep on here until we move on. But if I go back to like research and I'm looking at models, for some reason those investor fees are overstated. They're a little high, and that's a programming issue. Fidelity has to. Because you gotta understand, like what Fidelity's doing is they're taking feeds from like the universe of investments, all these SMA companies, all these fund companies, and they're sending all this data, and Fidelity's essentially packaging all this together into a platform where I can like sort and click and add and so just lost in all that translation, these fees don't come across right. But when you have a proposal, whatever's on the proposal is like that's that's the holy grail that everything's going to be based off of.
Okay. And then what happens when, like I have this case where it's going to end up being five different accounts. One's got 10 grand, 200, all different. When you put it all together, does that break point actually factor in? Or is it the fee? How does that work essentially for that client?
Well, I'm pretty sure, I don't want to tell you the wrong information. I'm not 100% on this, but like on Goldman, it's a per household thing, and I think it's the same thing here. But that's something you might want to
I'll check with
call
them.
advisory services about and see exactly how that works. But I know there's a householding. I don't know if it's per because at one point Goldman was like per social security number, and then they started doing it per household, and there was a transition there, and I think they're doing it per household, but I don't know that for absolute fact.
Okay. No
Hey,
problem.
hey Tyson. I actually just got off the phone with Fidelity because I have a case like that and it's per household. I
There
was
you
talking
go.
to somebody about that earlier today. Yeah, so
All
you
right,
can group
thanks,
everybody
Jack.
together. They all get the break points, all
Thanks.
that kind of stuff.
Yeah. Any other questions on building models or assigning models or building proposals or any of that kind of stuff? Hey guys, this is cumbersome. It takes a little bit, but let me just show you one other thing I want to come back to. Let me get out of this and go back here. So I want to go back to research and oops, I did it again. All solutions. And so a lot of what we've done so far, and this will be a good kind of thing to finish on, is kind of what you're gonna do for most of your clients. For most of my clients, I'm gonna build out models, assign them to models. But as you get to higher net worth clients or maybe more unique situations, there are some really, really cool things you get to. In fact, it's kind of tricky to show you. I'm just gonna explain it. But if you go into, let me see if I can actually. If I go into this SMA category, I'm going to stretch this out. So for instance, um, let me think about what I'm doing. Here we go. All right, so see these PIMCO managed bond ladders, okay? These municipal bond ladders, and there's corporate bond ladders. Um, so let me pick this like I'll stay on this screen for a sec. So notice these strategies have a $150,000 minimum. But I want to remind you what a separately managed account is. What a separately managed account is it's an account that is personally custom managed for your particular client's account, meaning their actual accounts being managed. So in a fund strategist portfolio, your client owns, it's more like a mutual fund where you're owning like shares of an ETF or shares of a mutual fund. And when that mutual fund at a global scale buys Coke and sells Pepsi, like that's happening in pro rata your shares. An SMA account is you can actually see the actual trades happening in your own account. Okay. So for instance, if any of you have like the Congress large cap value or growth, whatever it's called on Goldman, um, you can go into transaction history and you can see all the holdings. You can see what stocks are in the fund and what buys and sells are done. That's a separate managed account. Well, this allows us to take this to a whole other level. So, for instance, if let's say you have a higher net worth client and you want to build a bond ladder is a great way of managing fixed income. So instead of buying a bond mutual fund, where there's transactions happen that might cause tax consequences or different effects, you can build a bond ladder, and if you're over this $150,000 management, you can have PIMCO personally managing for 22 basis points your client's bond ladder. So think about this. Instead of me being an expert on the municipal bond market, and we live in Ohio, for at least for some of us on the call. So in Ohio, if you buy the state municipal bonds that is in your home state, they are state income tax free. And all municipal bonds, or almost all municipal bonds, are federal income tax free. So it's a tax free yield to your client. And so you can have a custom built bond ladder, and you can have PIMCO manage it for you. So if I click on this like 3 to 11 year, that just means the duration. They're buying bonds that mature 3 to 11 years. And then every year bonds mature and then they rebuild the ladder. And this is a way of managing interest rate risk or duration risk where if interest rates move a bunch in the interim, that can throw bond prices off. But if you constantly have bonds maturing, you always have income coming in. And so you can go in here and under composition, it's going to give you like a general holdings of what's in a lot of their bond ladders. But your account is going to be different than this because it's a separately managed account. And so, once you get deep into this, this is a platform where you can have a $10,000 account managed really efficiently, and you can have your $5 million client, you can get as custom as you want to get in terms of building bond ladders and SMAs, and you can do a values overlay, you could do a tax overlay. So I said all that to say, that's the value of this platform. And I got to be honest with you, and this is the last thing I'll say, is that I was a little resistant to FMAX 1.0 3 or 4 years ago, and I talked about that last time because the way it was built was just really stupid for our platform. The breakpoints were too high. It was just too cumbersome. But this new generation of like from Michelle Berry on down have come in, and once they kind of got their assessment and everything, they're like, well, Fidelity's definitely like you chose the right vendor. It just wasn't built the right way, and you didn't have the right people programming it. It's essentially what it come down to. And I'm like, I don't know, guys. Like, I really, I've had Goldman for so long. I like this, I like that, I like this. And they kept talking to me about like, yeah, but it's not a platform. I just didn't know what they meant by that. I'm like, well, how's Goldman not a platform? And, you know, and then you get to things like this and you start understanding like the depth that you can go to. And so that's why I love like, it's okay that this is complicated. You don't have to figure this out by Friday. But this is where you can plant your flag. And as you start becoming more and more of an expert on this and getting more comfortable, and you think about what that looks like 6 and 12 months and 5 years from now and 10 years from now, this is going to be our flagship platform for as far as the eye can see. But there's nothing wrong with Goldman Sachs. And so I'm not going to just shut my business down and, move everybody. But as I do annual reviews and it makes sense and I get this thing up and moving, I'll start porting over clients as I can. But I feel really good about the time invested in this because this is definitely our long-term future. I mean, we signed a huge, robust, long-term contract with Fidelity. We are in bed with Fidelity and they are in bed with us. And I can confidently tell you that both TFA and Fidelity are currently massively underwater on human capital and time invested in building this. We're both kind of working towards making this up in scale. And so I think it's an investment worth making. And anyways, I think we've covered about in 2 trainings here as much general training as I think we could do, short of literally going through the forms and setting up an account. And that's just a process of fumbling through that the first time. And we actually have support you can call. You can call TFA Advisory Services, and there's people that have been trained to help you get your Fidelity accounts opened up. And we got real humans in real positions now and all sorts of training to come. So, anyways, hopefully we've added a lot of value. Any final questions before we wrap up, today's session?
Thanks for your help,
Would you be
Tyson.
able to- Really appreciate it, Tyson. Would you be able to share the recordings?
Sure, I'll email this out again. Did I email you last week's recording?
Oh, I didn't. No, I didn't see it. No,
All right, I'll send that to you as well.
appreciate it.
We download these and put them on YouTube, and
Oh,
and that way they're hosted there, and so we'll send you the links to those videos, and then yeah, be all set. So hey, guys, get after it, and let's make it an effective week, and appreciate being in business with you guys.